Good morning, everyone. So lovely to see you this morning. My name is Pat Fletcher. I lead the Responsible Investment Association here in Canada, and it is my absolute delight to welcome everybody and to have the privilege of moderating this outstanding panel this morning. For those of you who are not familiar with the RIA, we are a member-based association comprised of asset managers, asset owners, retail advisors, and service providers who support our purpose to entrench responsible investment in Canada's financial ecosystem. We're obviously thrilled to welcome you all to Canada and have a convening of the responsible investment community. And I'd also like to point out, particularly relevant to today's conversation, is that the RIA serves as co-chair for the Joint Secretariat of Climate Engagement Canada. So for those of you who are not familiar with Climate Engagement Canada, or CEC, this is an investor-led collaborative engagement that seeks to pick up where Climate Action 100 stops off within Canadian industry to drive towards a net zero economy. So we have a fantastic conversation today, and we're going to actually start off by being a little bit interactive. And for those of you who've had your coffee, we'd like those who have made net zero commitments to please stand up so we could have a sense of how many in the audience are confronting and part of the conversation that we have today.
We do it as well?
Yeah, and please.
Oh, fine.
Great. Okay, this is fantastic. We have a great session in store for you. So the prime objectives of our session today is that we are going to aim to be practical. We're going to aim to be practitioner-based, and our goal is to equip you all with clear actions and insights on what has worked, what has not worked, and where we can all collectively drive to closer engagement around achieving net zero. We have a lot of ground to cover in the next 75 minutes. We're going to start off with a quick lay of the land from the CEO of CDP, who's going to focus on the corporate and company data insights they're seeing. And then we're going to have a quick Slido check in to see where you're seeing your biggest pain points or biggest challenges, so we can focus in our conversation in that area. And then we're going to have a fantastic panel conversation. And we have brought together a outstanding representation of the entire sort of investment chain to be able to share their insights and perspectives. There will be an opportunity to ask questions throughout, but we're going to possibly lay some of that towards the end. So with that, I'd love to hand over the mic and the stage to Sherry Madera, CEO of CDP.
Many thanks, Pat. I'm going to see if we can do it from here. Thank you, everyone, for giving me the opportunity as a proud Canadian who has been living abroad for 25 years to come back to my hometown and address a topic that means a lot to me, and I know means a lot to us all in this room. It reminds me of one of my favorite authors and one of our most famous authors from Canada, who once said, "It's not climate change, it's everything change." So those of you who may not know CDP, and a clicker would work, there we go. We are the world's only independent environmental disclosure system. Companies representing 2/3 of the world's market cap report into CDP, so very relevant to the investment community. That investment community stands behind us, 700 institutions strong, asking for the use of this data. We also use the data to work with some of the world's largest supply chain owners, and we report as well into governments and regulators to help shape policy making. So a quick note on Canada. Canada has a huge increase year on year in terms of reporting. So our data shows 57% increase in year-on-year reporting from Canada and Canadian companies, which is fantastic progress because that's building the transparency we need for action. But as we all know, there is much work to be done. So let's start with a little bit of philosophy, and then I'll get into the numbers. So we at CDP believe that reporting is the first essential step. In fact, we have some data that says after a company reports for the first time, within 2 years, their emissions go down by 7 to 10%. That is a fact. So while reporting takes effort, it is also reaping rewards. Environmental data is the bedrock. We see this as the bedrock for understanding impacts assessing risks, building sustainable futures. But it's not just any data, right? It's smart data, it's decision useful data. And it's really important now for us to build efficiency in making sure the data is in the hands of actors. CDP does not judge. We do not act other than being able to surface that information for all of you. So the same data that you're using to make sustainable investment decisions is exactly the same data point as some of the biggest buyers in the world make in order to be able to decide if they are going to continue doing business with that company. So this is a real golden thread that runs through not just investment. It's a golden thread that runs through a whole of economy approach to bringing net zero to life. So let's run with some numbers, and anyone who would like them, please do email me or the CDP team to get some of this data for you to look at. The key thinking that Margaret Atwood was putting out is everything change. Maybe we can convert that into our speak, which is actually transition plans, trying to understand how that transition works in multiple ways. So this is the targets are important, but what we're seeing is an increasing interest from the investment community on transition planning and how that is moving. Momentum is increasing year on year. 40% more companies have reported having a climate transition plan in place. But despite this progress, only a handful of countries, the companies within countries like Japan and France, are leading the charge with 1.5 degree aligned plans. So why is this important? Well, credibility counts. It's no longer enough to say that you have a target. It has to be what it is you're doing to achieve it. So again, CDP is here to be able to surface that information for you to take decision making and decisions on. So how do we do that? How do we support you? CDP has identified 21 transition plan data points that lead to a credible transition plan. And what is that all about? These are 4 main areas. It's governance, strategy, risk management, and targets. Those are the 4 areas that these 21 data points are associated with. These are all aligned with the Transition Pathway Initiatives, the TPI. So again, very much in line with best practice. So what? Again, and when we're thinking about this, we're surfacing the information. But the reality is that transparent plans are leading to action. These leaders, in terms of transparency and reporting, are also getting the money moving. Those with more credible transition plans are channeling more money towards green investments. In 2023, those reporting to the most credible plans also reported the highest proportion of CapEx alignment with climate transition spending. Nearly 35% of transparent plan owners have a positive correlation to being able to make sustainable investments. And this comes out of the vast amount of data that CDP asks to companies and to financial institutions to be able to surface what it is that's really going on. There we go. So, of course, I just skipped over targets. But the reality is a transition plan can't exist unless you have a baseline and you have a target. So they are absolutely important. Let's look at how Canada stacks up against the other G20 nations. These are the corporates within these jurisdictions that are reporting. So Canada is outperforming many of other countries in setting emissions targets, which is great news. However, there's a challenge because the quality of these targets are important. Canada, only 19% of the targets are validated as science-based, compared to the G20 average of 23%. So again, there's definitely more work that needs to be done. And overall, less than 1% of companies worldwide are reporting against all of those 21 criteria. So if you match some of those data sets about targets and amount of data that's going into the transition plan data points, definitely more work to do. So is the transition finance flowing? We've seen a steady increase of financial institutions disclosing through CDP. Thank you. It is a rise of over 70% year on year up to 2023. We're in the middle of the cycle. It's not too late. Come on and join us, please. I have to put the pitch in. Of those institutions, the majority are reporting on how they fund energy investment and provide climate mitigation and adaptation products. A minority have a portfolio target, something for us to think about and consider. As we're all aware, financial institutions are a service sector, and they serve and rely on the input data from their portfolio companies. That's why I started with the corporate data. Because the reality is as you're building some of your scope 3 emissions, your portfolio emissions, you cannot do this in isolation. You need to ask the companies that are in the real economy for that data. And bringing them along with why that data is being used, how you as investors and the sustainable finance community are taking into account that data is really important. It's also really important to make sure that we sweat the data that we have. Because that same data set, you are not the only ones asking for it. There are many other sources of requests to the same company. So really at this bedrock, at the bottom of trying to understand what that data is so we can measure it, so we can manage it, is the corporate. And that's not free. Their reporting costs money, and we need to respect that because we want to make sure that that balance between risk and return, between disclosure and transparency and profitability, it stays intact. So I think that we've made great strides, and I'm coming to an end so we can have a really interesting discussion with the group here. But there's a long way to go. CDP is proud to be part of this journey. We're part of, the part we play in the everything change is very clear. As the global boundaryless, borderless, jurisdictionless group that looks for comparability and compatibility that sits underneath all of the different use cases, be they access to capital, business efficiency, or compliance. We're here to serve. And being able to use that data as much as possible through a write once, use many, is going to help all of your investments make sure that they're spending every dollar, not on reporting, but on taking action. And that's something that we can never lose sight of. So thank you.
Thank you, Sherry. So back to all of you. We now know that you're very engaged. What we really want to do now is get an idea of what are some of the top issues you're confronting. So we're going to have a little Slido poll for you. And if we could solve, if one of the following issues could be fixed for you in your organization, which would you choose? So if you could go to the Slido poll app. The first one is setting portfolio decarbonization targets. The second is implementing targets and measuring progress against them. The third is better availability and reliability and consistency of decision useful data. And the fourth, engagement with policymakers and other investors. So we're going to leave this up as you all work your way into the app and respond, and we're going to come back to this and reflect on this in a little bit. But first, to kick us off, just to set some context, the topic of net zero commitments and implementation is not new. In fact, there was a session a few years ago at PRI focusing on tackling these implementation challenges. And some of the themes that emerged at that time were the important role of stewardship and engagement in helping to move forward on commitments, the realization that isolation does not work, that narrowly defined portfolio and decarbonization is not good enough, the need for the data industry to be working together to improve consistency, and a clear need for localized frameworks that take all of these challenges into account. But that was 2 years ago, and a lot has changed since then. We now have much more political pushback. We have an urgent case for action, more so than ever before. We have increased recognition for a strong call for an enabling policy environment. And we need to mobilize capital and get investment in climate solutions and scale up the climate technology ecosystem. So with that, we're going to start to head into our panel. And as I said, we've got a fantastic mix of perspectives. We've got globally diverse participants representing various actors in the investment chain. We have asset owner perspective, asset manager perspective, the data provider service view, as well as the private markets view. And what we're looking for is a very pragmatic approach, honest conversation, and how we can all work together to move the dial. So with that, we're going to have everyone kick off with introductions. We're going to have your name, your organization, and how you've committed to net zero, and what has been achieved so far, and what has not worked. So it's a lot to unpack just as you introduce yourself, but we'll start with that. And I'm going to hand over to you first, Dave.
Well, thanks, Patricia. It's great to be here. And thanks to PRI for bringing us all together. It's great to see so many old friends here, so many kind of new people as well. And it is really quite a unique forum, really bringing together change makers from across the global investment industry. So it's really special to be here. But I'm David Harris. I'm at LSEG. We made our net zero commitment back in 2021. So it was kind of just ahead of COP26 in Glasgow. And initially, I've got to admit, it was quite focused on a lot of our operational related stuff. It was a bit lighter touch on our products and services. We did put together, we've had a couple of iterations of transition plans, which have got better. They've been up for shareholder votes as well, and the shareholders overwhelmingly supported the transition plans. And then there's been quite a lot of work over the last 18 months or so with the Net Zero Financial Service Providers Alliance, and that's been helping us give a more structure around how to set targets as an exchange, as an index company, and also through our data and analytics division as well, in terms of the kind of data and analytics we provide. But actually, I did want, if it's okay, maybe I could cover off a bit about what's worked, what's not worked later. I was keen to kind of cover off a bit about the survey we just did, because it was very different results to we do an asset owner survey every year. We've been doing it now for over a decade. And the last one just got published about 10 days ago. And 300 asset owners from around the world responded. And some of the stuff was a continuation of the trend. So like we hit over half asset owners saying that they were integrating sustainable investment into their strategies about 5 years ago. It's now like 80, 90%. And climate change remains the top priority. But quite interesting, there were some things which completely changed this year. So one of them was reflections on regulation. So up until recently, asset owners have actually seen regulation over the last couple of years as being a barrier to implementing sustainable investment strategies. And that changed this year. That dropped right down. And in fact, 90% said that they found that regulations were helping them implement sustainable investment strategies. So that was kind of interesting. The other thing which actually differed to the results we were just looking at, which was about the data. So a big concern, I think, since we've been asking the asset owners what their biggest challenge is, it's been about the availability, the reliability of data, concerns around estimates. And actually, there's much more confidence in the data this time. So that dropped right down. And instead, there was much more concern around things like implementation, how to kind of hit quite specific quantitative climate and sustainability alignment objectives for portfolios. So quite a bit of shift. Actually, one other I'll say before handing over, which is that there was also the first year in the 10 years we've been doing it, that there was actually more asset owners looking at how they integrate sustainable investment into passive portfolios and indexes than actually into active strategies. And that, being somebody who's spent a long time working for FTSE Russell and our index business, that was quite exciting.
Yeah, very, very excellent. Thank you for sharing. So over to you.
My name's Kate Turner. I'm the Global Head of Responsible Investment at First Centre Investors. So we're a global fund manager, but we're headquartered in Australia. And just a little bit about our business. We have 11 investment teams. We invest across listed equities, fixed income, direct infrastructure, and private debt. And I think, so we set our net zero commitment in 2021. And at the time, it was really challenging for us because our business model is an affiliate style model. So the way that we approach responsible investing is, whilst we have a central RI team, which is the team that I head up, it is the individual investment teams that do their own ESG integration, voting and engagement. We work very closely with them, but we feel really strongly that it's them that should be using those tools as part of their broader toolbox in terms of the way that they own companies. So for quite a decentralized model, it was sort of a difficult mindset to come together and say, well, how as a firm can we set a net zero target? So I guess starting with what doesn't work. I think for us, thinking about things at asset class level just didn't work. Like in the listed equity space, we've got 7 different teams. They invest across developed markets, emerging markets, small caps, mid caps, systematic, quant. We've got infrastructure, property strategies in there. So thinking at an asset class, how do we want to decarbonise or how do we want to make a net zero commitment didn't work. I think what worked for us was to really think about it bottom up, investment team by investment team. What is a realistic target for those teams and how can they work individually to use the leverage that they have, and then how can we come together as a firm? In terms of what worked, I think what has been really useful over the past few years of implementing this commitment is to really think through where do we have direct influence and where do we have indirect influence and where do we have very little or no influence, and thinking about that really pragmatically in terms of how we spend the time that we have. Is it better to be spending it on company engagement? Is it better to be spending it on policy advocacy? Because I think that has saved us a lot of time in terms of the engagements that we're having with the companies that we invest in, and also in terms of the wins that we're having on the policy front.
Excellent. Thank you. That's insightful. Great. Thank you. Bertrand?
Yes, thank you. Hi, everybody. Bertrand Milot, Head of Sustainability at CDPQ. The Quebec Pension Plan, $450 billion. We're invested in 6 asset class, 70% equity, about 60% private, 85% internally managed. So we follow the Canadian model of direct internal management. We started our climate journey in 2017, had worked on defining a strategy and set targets to invest in green and to start decarbonizing the portfolio then. In 2019, we made a net zero commitment. We also were a founding member of the Net Zero Asset Owner Alliance and continued the journey, increasing targets, increasing ambition. In 2021, we set another target to actually invest in brown to green. When you do that, you actually increase the carbon in the portfolio as opposed to decreasing it. But we all know it is very important, and we embarked on that journey as part of a separate sleeve. What was really important to us was the fact that we linked remuneration of everybody at CDPQ to achieving these targets. It sent a very clear signal. This is important, and it is important because climate is a huge investment opportunity for a pension plan that is invested in the long term, but also we need to manage the risks that are associated with climate change and with the energy transition. Linking it not just to investment teams, but to everybody was also very important, because suddenly we had the ear of IT, of accounting, etc. All the internal services that we needed to get the data, to scrub the data, HR to help with pushing the message, etc. We also, useful tools, we imported external taxonomies to CDPQ, CBI, SBTI methodologies, which made it very easy to have the dialogue. You know, our investment colleagues are negotiators at heart, obviously, and they would say, well, this is green. And it's like, no, not quite. But it wasn't me saying it, it's CBI. So it helps from a management point of view, and that was very, very useful to push the message. We established a transition risk framework. We have a lot of physical assets, over $100 billion of physical assets, and therefore we also have developed a practice on physical risk, which is very important. We do a lot of engagement of companies internally, public, private, and climate is part of the language. So it has worked remarkably well, I should say. Today we have tripled our green assets to $54 billion, which is about 12.5% of AUM, and have reduced the carbon footprint by 60%, 60, since 2017. Now it's gone very fast, and that is the problem. This success has been, well, we've decarbonized the portfolio, but as we know, the planet is not decarbonizing as fast. And so it was all these mechanisms and tools were very useful to get the organization to jump on the bandwagon and start singing from the same hymn sheet. But be careful what you wish for. So the culture is there, it's good, but we need to shift the direction. We need to put a lot more emphasis on corporate alignment of corporate transition plans, shifting the focus from carbon in the portfolio to the directionality of carbon within portfolio companies. We need to also find ways to increase our exposure to brown sectors. So far, our transition efforts have been mostly in the power sector, mostly coal-fired, that is being converted to other sources, green and other fuels. But we really need to shift that debate to focusing on decarbonizing the real economy. Thank you.
Standing. Thank you. Elsa.
Yes, thanks. Delighted to be here, everyone. My name is Elsa Polonza. I'm the Global Head of Sustainability and ESG for ICG. We are a private markets player, and delighted to be representing the private markets voice in this coalition here. We are a multi-asset alternative asset manager listed in London, and have under our domain structured to private equity, senior debt, credit, and real assets in the form of real estate and infrastructure. So we were one of the first alternative asset managers to set a net zero goal and science-based targets associated with those in 2021. The net zero goal is tied to the investments where we have sufficient influence to really make sure that we're actually following through on that portfolio coverage target with our science-based targets. We naturally set an operational science-based target as well, but understanding that that's good housekeeping, it's necessary for all of us, but it's not the most material or important factor for us as a financial institution. So we're really focused on that portfolio coverage target, noting that within those assets where we have 25% equity or more and a board seat, which is the threshold set by the SBTI, we have set a target of hitting 50% of those by 2026 and 100% by 2030, and then the net zero goal is set for 2040. So I'd say that, in the private markets, you have a pretty wide spectrum of activity happening when it comes to decarbonization. And probably important for me to note as well, although our net zero goal is specific to those particular investments, decarbonization is a primary theme across all of our investments. We make that inherent to our pre-investment assessment and then certainly in our engagement efforts post-investment. I think what's working, I would echo what Kate said about engaging with the investment team. Naturally, if this is something that's seen as an adjacent activity to your core investment practice and the building of business models and the inherent nature of investing in a company and working with them to grow their capabilities, then it's never really going to work. So how are we making sure that that's happening? In our pre-investment assessment process, we understand the baseline efforts of what's happening in that company. In our mid-market portfolio, sometimes those are very, very nascent. These are companies that are in growth stage. They may have done some baselining of their carbon emissions and some of them not at all. And so we know we need to start from a very early starting point. With the large cap portfolio, there's maybe a little bit more work that has gone into that, but we know that we need to accelerate that rapidly. So it's a matter of building that in early and often, setting expectations with the management team, and then, of course, working on a plan for how exactly we're going to work on building the baselining and setting targets thereafter. We've had a lot of success with the target setting, and that's great, but it's also important to note that the setting of the targets is just the first step, and then following through on those is the most important part. And so I will say we're hitting, the rubber is hitting the road now when it comes to making good on the targets, and I think it's, of course, what we want to see in our portfolios, that you're seeing high growth. There's mergers and acquisitions happening. There's opportunities for these businesses to grow significantly and produce great returns for our investors. And along with that comes the inherent challenge of making sure that the decarbonization efforts are keeping pace. Sometimes that means rebaselining. Sometimes that means taking a savvy look at where and how those businesses that are coming together are able to sort of collaborate and maximize the capabilities of different business lines. So it differs business by business, but I think that there's a lot more happening in the private markets than maybe people assume. And so it's exciting to see that this momentum is happening, not just for us, but for my colleagues as well.
Yeah, agree. Very super. So I thought at this point, if we could pull the poll back up, and just take a moment for everyone to sort of reflect, and we'll see if that's possible. And give the team a second to pull the Slido back up for everyone to see in the results. So, David, you shared your reflections, but the number one here, better availability, reliability, and consistency of decision useful data. Reflections or thoughts on that? Does that align, Kate, with what you're feeling, or and maybe your perspective on that?
Yeah, that would be my magic wand wish as well. I think data has come a long way, and I think since we originally set our net zero commitment, and over time we've evolved our framework, and the data that is supporting our assessment of companies' alignment with net zero is just so much better than it was several years ago. But there's still so much more to do. So I don't think data should ever be an excuse for not getting started and not doing something. But I wish it was more available, reliable, and consistent.
Yeah.
Yep.
It's a significant challenge. Bertrand?
Yes, I would echo this. Data is an issue, but it's not an excuse not to start. And I think, the important thing with climate change is we need to shift the finance industry from having a culture of, the first reflex is to do linear regression over 20 years, to looking in a crystal ball, because that is what we're doing. Nobody has been there. The planet is on a path that there is a crystal ball, and we need to all get comfortable with the fact that data certainty is not going to happen. Companies are going to do projections. It'll be suggestions. It'll be more or less correct. And we need to really get comfortable with that. And that's part of the cultural change within an organization, to set targets and to look forward, as opposed to through the lens of analyzing capital markets in the past.
And Elsa, you've got a very unique lens on that.
Yeah, so I think, as I mentioned, and I came from banking prior to moving into the private markets, and so it's been an interesting shift to see where and how this data question has adjusted. There's no doubt that the data is an issue across the board, and if I thought it was challenging in the public markets, it's sort of doubly so in the private markets. I agree with Bertrand. I mean, we can't lean on this as an inhibitor or a hurdle from taking action. Naturally, our data sets will continue to grow and get better the more that we're all able to lean in. And I think that's where this dialogue across the capital stack is so important too, because if we are integrating this into our engagement with companies early and often as they're growing larger, ostensibly they might become listed and they might become those equities that others are investing in. Capital flows coming in from banks, helping to incentivize that. This is the kind of collaboration that's really necessary, and I think is really what this conversation is about. I think also that there's no doubt that the data will continue to grow. We haven't talked so much about regulation yet, but this is a sort of outside-in force that's
Right.
There's a lot of hope, I think, in the European context in particular, that with the incoming CSRD regulation, that the amount of data necessary for the businesses in which we invest to become public, hopefully that rising tide will lift all boats. There's no doubt this is going to be a hurdle, and there will be a messy middle before we kind of come out the other end. But certainly if efforts can continue to line across disclosure recommendations and regimes, I'm hopeful that will contribute as well. So it's both sort of a grassroots effort, us working with our portfolio companies, and then that outside-in influence.
Sherry, your perspective?
Oh, this is my home turf, isn't it?
Yeah, you can't avoid it.
So I am enjoying the panel saying something that I say often, which is, let's not make the perfect the enemy of the good. Let's make sure that we are using the data that does exist and find ways to make that, make our ask for data really clear. Because actually, as the CEO of CDP, you might expect me to say, we want more data. No, we do not want more data. We want more decision-useful data with more data density so that you have comparability across borders, across industries, across sectors, how you want to cut it. And that doesn't come from estimation and extrapolation. That comes from disclosure by companies. So I think that is something important for us to be thinking about, which is, are you using the fact that you don't have the data point you would like as a scapegoat for action? Sometimes I'm seeing some of that. So let's figure out a way as an ecosystem to actually step into the shoes of the CFO of any of these companies or organizations that you are working with. It costs that person, that CFO, that CEO, the board, it costs them money to be able to disclose data, even scope 1 and scope 2, which is very much within their bounds. Let's think about scope 3, which is all about the supply chain, which means that they have to ask their supply chain to disclose that data. And so that is a knock-on effect in terms of a cost to each of those supply chain members. And it doesn't stop there. Understanding the transition plan and what elements are from that. So I would say that what we should be thinking about is driving efficiency, because we don't want the money spent on reporting. We just want the data to magically appear. And that doesn't happen either. So I feel like what we need to do is speak continually the language of the business, speak the language of the CFO. And I think that as an NGO, that's something that we are changing dramatically at CDP. Because if you aren't able to tell the CFO, this data point is going to help you access capital, create business efficiency and retain clients, and be able to have a compliance-led approach, that same data point, the ABCs, we're going to keep it simple. Those are the ABCs of what a CFO wants to hear to be able to make that investment. So if we're all on that same page, I think that then we're driving efficiency, and that I think is going to be very effective. The last thing I'll say about this is we also need to be aware of the limitations of data in the world right now. So for example, some of the companies that you all invest in are multinational companies. Some of them have very significant factories or generating some of their emissions and output in areas around the world that are far less mature than perhaps a headquartered-based organization, be that in the US, be that in the EU, be that in more Japan. And we just need to sort of realize where the journey is at various different points, both geographically as well as sectorally, and be able to actually be transparent about that. And that's something that CDP is dedicated to doing going forward, is being a lot more transparent about how hard or easy a data point is to reveal, so that we can continue to capacity build and be that partner for each of you in making sure that the data that we're collecting is decision useful. Not all data matters. And we need to make sure that we're honing that down.
Thank you.
Maybe I could just also come in on the data point. Coming from a data company, this is pretty relevant. And I think we have to recognize just there has been an incredible improvement over the last couple of years. So we had Emmanuel Faber yesterday at the PRI policy session. ISSB has been a huge success in getting, IFRS, the kind of global financial, standards body, to pick this up and to come up and move very quickly. And now countries after country getting on with implementing that. I think many people here in the room also there's a call to action that we did together with PRI, also with the World Business Council for Sustainable Development and the UN Sustainable Stock Exchange Initiative, saying to governments, we all want you to get implementing ISSB and to get going on it by 2025. And they had 120 organizations, not just investors and lots of investors support, but also getting the corporates and the exchanges to call for it as well. And so we've seen that. If you look at the largest 4,000 companies in the FTSE All World, about 75% of companies are now reporting Scope 1 and Scope 2 data. On a market cap basis, it's 90%. But the Scope 3, and I think we have to be also honest about where there are issues, and the Scope 3 data is still deeply problematic. So out of that 4,000, it's only 45% that are reporting Scope 3 data today. And then if you look at what they're reporting, and I think this is also an action area for all of us, is it's up to companies to decide which of those 15 subcategories of Scope 3 are material for them to report on. And they pick up a whole range of different, often, business travel is category 6 is one of the most reported ones. It's often not the most material. We think it's only 20% of companies are actually reporting on their most material subcategories. And then even amongst those, they're changing it year on year. So you actually get to about 10%, which are fairly consistent. So I think what we all need to do is actually put a bit of pressure on GHG protocol, also on ISSB potentially as well, to be a bit more prescriptive in saying which categories of Scope 3 emissions are the material ones. And I think that's helpful for companies, but it's also helpful for all of us in getting more accurate information. And again, it's not about not using this information, but it's using it with that knowledge and that understanding, and also trying to find alternative proxies sometimes instead of always trying to use estimated emissions data.
Excellent. Appreciate the focus and the candor. While we're being honest and candid and aiming to be practical, let's talk about what it's been like and what the journey from commitment to implementation has looked like. And is this where you thought you would be when we started out, or when you started out? And Bertrand, I'm curious to speak with you as one of the first sort of early launchers about, as you sit here now in almost the end of 2024. Looking out, is this where you thought you would be, or what have we learned along the way?
Yes, I mean, we're certainly, as I said, very, very happy with the way things have gone. And, we managed to, invest in climate solutions and decarbonize the portfolio without denaturing it by being smart in the choices that we made, which is good. I think I would say the power of collaborative initiatives is very, very important on that journey, has been, whether it's the Net Zero Asset Owner Alliance, which is helping guide methodologies, the PRI, the Climate Action 100, Sustainable Market Initiative, etc. Those organizations help with framing the debates, setting standards. I was yesterday at an event with the Transition Pathway Initiative, which is, has a methodology to define the trajectories of companies going forward. All these things are very useful. And I think it's very important to collectively work on those methodologies, those tools, use them, speak a common language, because we need to push companies in the same direction. We need to push governments in the same direction, and this is the next phase, I guess.
Excellent. Kate?
I tip between optimism and pessimism in terms of how far we've come and where we are. Because I think obviously, where the world is, we need to do more, we need to go faster, we need to go harder, and that kind of involves everyone. We reported to our investment committee and our board. We do it once a year in terms of our progress on where we're at with our net zero targets, and particularly focused on our 2025 targets in the short term. And I was actually, I was really pleasantly surprised in terms of where we are and in terms of us being on track. And it kind of reminded me that whilst there is so far to go and so much to do, it's also really important to celebrate the small wins that we're having in the meantime, because as I said, I was really surprised, but I shouldn't have been, because we've been working so hard the last few years on this, so we should be making progress.
It's an important point, because sometimes the environment's changing so quickly it doesn't feel like it. So it is finding your pockets of optimism are very important. Elsa, you've come through sort of quite a trajectory of experience in your background. So you started somewhere completely different.
Yes, exactly. I was privileged to be in the banking world when the Net Zero Banking Alliance was launched, and saw a real sort of center of gravity shift, I think, in that space. And obviously there's ongoing work happening there. And now it's been really exciting to see the amount of momentum that's happening again behind the scenes in the private markets. I think this vantage point is really interesting because we have the opportunity to go company by company, very intentionally embedding these principles into the very fabric of the businesses that we're working with. And each one of those is a win. And I like Kate, I think that you have to celebrate those moments and realize that actually, if we're doing this properly, we're actually building the companies that will befit the next generation economy. These will hopefully grow into the next big companies that will be driving the economy in a macro way. And if this is actually part of their DNA to begin with, that's a great thing. I think that the macro picture still has a lot of work to be brought together all across the capital stack. I don't think quite have the connection points fully plugged in the way that we could. And that's why these conversations are important, as I said before. I think that it's great to be making progress, and ultimately, when we see a sense of direction going in certain industries, and particularly when you see opportunities arise for companies associated with their decarbonization or net zero goals, that's the best incentive that there could possibly be. So we've had companies that have, seen huge cost savings and access to whole new markets by setting these targets. And I think that can't be underestimated in terms of setting a great example. Their peers are watching, and that naturally sort of moves industry by industry along.
Yeah, it's very exciting in that space.
I can put some numbers to that.
Great.
So we did a study about opportunity. And I guess if the question is, are we where we should be? I think we're getting to a point where we're starting to think about where is the opportunity as well as the risk and the downside. So some of the work that we were doing, it's specifically for Europe, that the companies that disclosed to us have cited 3.47 trillion euros worth of opportunity in terms of investing in new products or in new ways of working. Because they're looking at something through a sustainability lens. 3.47 trillion euros. And of course, we asked the other question, which is, what is that going to cost? And the number that came there is 620 billion euros. So I'm sure that a number of you would leap up and say, I'll put the money down for some of that. And that's, I think, where we get stuck, which is that we're starting to identify some of those opportunities and then being able to surface it to the right communities so that those data and that revelation is getting the money and moving the money, I think is really important next step. So accelerating that would be important. And that's big picture, right? 3.47 trillion euros, that's a big number. But what I'm actually quite excited about is that where we're going is some innovative financial products that are actually much smaller in individual scale. I'll give you an example. So supply chain financing, sustainable supply chain financing. And that's actually happening really robustly across the world. We're really proud to be working with Walmart and HSBC in order to be able to deliver a lower cost of capital to suppliers who supply Walmart and disclose to CDP. That transparency is being rewarded in terms of basis points. And I think that may seem like a small, minor thing when you're talking about sustainable investing and moving money, but it absolutely adds up. And that, I think, is something that we should be talking more about, which is where are the opportunities? How is it that finance plays a role not only in moving capital at scale, but in innovating to find other financial products that are going to be able to, again, sweat that data that companies are using to be able to move forward. It makes a difference.
Excellent. It's exciting. David, do you have anything to add in terms of that?
Yeah, I suppose where have we got to, and I guess in relation to our own net zero targets, I guess over the last 18 months, as I mentioned, there's been a lot of kind of coordination on one hand externally, working with the Net Zero Financial Service Providers Alliance in all of these subgroups. We've got an exchanges subgroup, there's an indexes subgroup, there's a data and analytics one, and then we've been trying to work out with those groups, well, what does net zero targets mean for each of these areas? So what kind of goals should each of us be making? And we need to have a consistent framework. So there's been on one hand that, and then internally we've then been, actually because we've got these quite distinct businesses doing each of these areas, trying to make sure we've got consistency in thinking across all of them. And so just in June this year, we finally published our product goals based on that. But it was quite a helpful exercise, and actually, if we can get joined up on this, we can also help markets get joined up on it. We're engaging with companies, helping them raise capital on our markets. We're obviously also providing the data and the tools to banks and to investors. And so getting that kind of consistency in approach, I think, can also help these different parts of the market better understand each other.
Excellent. Upping their game. Fantastic. So let's change gears and get a little bit more future focused and talk about top priorities. So what are your top priorities as we focus on actual real world impact? And I'm gonna tee off again with you, Kate.
Sure. So in terms of our climate action plan, we've got our 5 Cs, which, gosh, I hope I remember them. There's company engagement, collaboration, clients, consistency, and clarity. And so we've got actions around all of those things that we're focused on doing. If I think about where is the most real world impact, I think it varies from one day to the next and from one situation to the next. One example I would give that has been sort of a great source of frustration for me, and I'm sure many other people in the room, is engaging with a company and trying to get them to change their behaviour when there are policy settings in place that are incentivizing them to do the opposite is a very frustrating experience, and it kind of leads nowhere. And I think it's an experience that we've had a lot in Australia over the years because we haven't had the policy settings that we need, and we still don't, but we've come a long way in the last few years. And so where we tried to shift gears on that is really to really ramp up what we're doing on policy advocacy. And we've been fortunate in Australia over the last couple of years that we've had a government that is much more receptive to that and much more receptive to the needs of investors, which then comes to the piece of, well, how do we do that most effectively? And I think we've a lot of us have talked about collaboration, which I think is a really important piece. One piece of work that we spent a lot of time on last year was with the investor group on climate change, the IGCC in Australia, who had been talking to the government a lot about the need for sector decarbonisation pathways in Australia. And they coordinated a lot of engagement with investors. Our CIO went down to Canberra with a group of other CIOs to talk about what they are and why they're needed and why we as investors need them. We sponsored and supported IGCC in putting a paper together for government on what are sector decarbonisation pathways, what aren't they, why do we want them as investors, and what do we need from them as investors to really clearly articulate, not that we just need this piece of policy, but this is exactly what we need this piece of policy to do for us. It was a really fruitful conversation. The government then commissioned the Climate Change Authority to do that work, and the sector decarbonisation pathways were released in Australia last month. Back in September. So now going from kind of having a conversation with the company to say, we need you to kind of decarbonise with this trajectory, we have an actual trajectory that the government has commissioned that we need them to decarbonise in line with. So it's just completely shifted the game in terms of the engagement that we can have with companies. So in terms of real world impact, it's never one thing or the other, but it was that we needed to do that policy advocacy work first to get the policy settings in place to enable us to have those meaningful engagements with companies.
Outstanding. Yeah, all the important puzzle pieces there.
Yeah.
Bertrand.
I would say three things. The first one, and there's backlash against reporting. The way we view reporting is, okay, we need information, but that's this number two. Number one is to make sure management teams of portfolio companies have something to say. It's easy to tell a story if you have something to say. But if you don't, the TCFD report might look like a daunting task, and that's precisely the point. To make sure that the management teams of portfolio companies consider their strategy, consider their supply chains, consider their threats and opportunities that climate change pose, and think about it. Think about it because they might use that as a competitive argument to reduce their footprint to their suppliers, and comes back to what CDP is doing. It's also a way to make them think about climate risk, physical risk, and we're doing that hands-on in our infrastructure portfolio, where we are telling companies, we have large positions, we're on the boards, telling companies that's what we want you to do. Very important, because we want that culture to be there in the portfolio companies, and I think we need to generalize this to all companies. They need to think about it. If they report that there is nothing to say about it because they're an IT company somewhere in a building, somewhere in a city where there is no risk, fine, but think about it. The second is we need to continue to invest in pro-climate solutions, green assets, adaptation, enablers, all these things. It's very, very important that more capital is pushed in that direction to provide solutions to help decarbonize the economy. And this is a road that we've been on for a while, but we need to continue doing that. The third is to have a much better policy debate, much more applied to real-world decarbonization. And I was encouraged. I was at Climate Week 2 weeks ago. And, compared to a few years ago, where there was this great enthusiasm that finance was going to solve everything, let's go and let's do this, it's going to be easy, we just need to deploy capital. The tone at Climate Week this year was much more realistic. It's going to be a long, hard slog. It is going to be difficult, but we need to do it. You might say that sounds pessimistic. Actually, no, it's optimistic, because this mere realizations, that means that we're now having real conversations about how to decarbonize individual sectors. You know, cement needs to have policies for cement. Steel needs to have policies for steel. You think what has been done with electric cars. Governments have set, you know, mandates by 2035, no more internal combustion engine. And they've also subsidized the sale of electric cars, but nothing has been done for charging networks. And it's very difficult to make money with charging networks. And so you end up with this conundrum that, well, people don't want electric cars because it's difficult to charge, etc. And it's like, that's the kind of maturity that we need in the ecosystem. So I'm encouraged, but we need, as investors, to help companies and governments have that conversation to find solutions to make it happen.
Thank you. Elsa.
Well, I think there's no doubt that for us, we will continue to prioritize our own portfolio in terms of company by company, ensuring that we're making those decarbonization targets, you know, a reality. We've focused in on materiality, on ensuring that we actually did an internal exercise recently and looked at the sheer number of ESG across the board, environmental, social, and governance factors that we were asking our portfolio companies to give us, and had a real moment of humility and reckoning internally to think, gosh, how many of these are we really using? And in turn, how many are our LPs asking for? Our clients are, you know, pushing their requests down to us. Naturally, it's our responsibility to ensure that we're deploying that capital wisely and reporting back to them. But I think this dialogue around how do we make sure that the efforts organized around data points are actually yielding action on the other side, that's really critical. Going back to this point about LP-GP dialogue, we had a great session yesterday focused on the private markets specifically, and I think there's a huge amount of desire on both the asset owners and asset allocators and the asset managers in the private markets to be thinking about how we coordinate and collaborate to focus across this myriad matrix of regulatory obligations that's coming on all of us, and how do we then utilize that to make sure that, again, we're taking the most important information, passing it up the chain to our clients, and making sure that we're focusing in on those factors with our investments themselves. I think it could be, we could be stuck in this middle space where all we do is focus on rounds and rounds of reporting if we're not careful. Yeah. And although those are essential obligations, I think there's this opportunity for us to sort of crack our way out of that and think about how do we actually reorient ourselves to making change in the real economy. And surely that's going to require, again, we keep saying it, but this effort to collaborate and focus in on what is going to actually streamline those efforts to make sure that the action is the most important part and not just the reporting.
So I might sort of fast track to one of our questions. I said I wouldn't throw you any curves, but I'll throw you the curve because we're going in that direction. What are you seeing? We talk a lot about collaboration, but what do you see as barriers to you know, how can the barriers be addressed through collaborations and alliance levels? And are there any barriers to actually creating some of the collaborations? What are you seeing?
Maybe I could pick up that up and maybe link it together with kind of the real world impact and then the collaborations. But because one of the things which I think enables real world change is when you link investment decisions and capital allocation to engagements and you fit those things together. Too often there's a focus on an overly kind of quantitative emissions reduction figure. You're trying to hit a kind of a wacky or, you know, kind of weighted average carbon intensity reduction year on year. And it just takes high carbon sectors out of portfolios essentially over time. And actually it's these high carbon sectors which really need actually engagement and capital to transition. So it was great actually hearing Bertrand earlier on talking about actually focusing in on some of the high carbon sectors, because that's where a lot of the change needs to happen. And so what has been quite exciting has been seeing some of the collaborations around engagement. We kind of TPI, the Transition Pathway Initiative, got mentioned a couple of times. Sherry mentioned it, so Bertrand did. But that's been a very powerful mechanism for investors to come together and to set up an approach to engage companies around their climate transition plans and get the focus on the forward-looking stuff. And then from, you know, sometimes it can be frustrating when we're providing sometimes indexes for clients where there's too much focus on the kind of backwards-looking data and on things like WACI, but what's been quite exciting is actually building TPI into the design of passive portfolios. And where you then have got, as companies improve, as they've been asked to do, and as the corporate engagement takes place, their weight in the indexes starts to go up, so it reinforces that engagement. And so that's an area where it's a kind of a natural way to kind of collaborate. To not only is it that individual investor engaging with the company, but actually it's based on a set of methodology that's feeding into Climate Action 100 Plus. So it's aligned also with the kind of Canada engagement, Climate Engagement Canada program as well.
Yeah.
And so that's, I think, a really effective way that collaboration can help link it into investment strategies and join up that capital allocation and engagement.
Excellent. So we're coming into our last 15 minutes. We're going to go through one more of our panel questions and then see what we're hearing from the audience. But I think what we wanted to sort of get is a bit of a view on what is needed from asset owners, asset managers, LPs, and GPs, and service providers overall to really help move the dial. So I'm giving you a broad question, but this is where we need to come together. And sort of sharing your perspectives if you had the opportunity to sort of say, what does good look like? And I'm going to start with you, Sherry, at the end.
Big question. What does good look like? And I'm going to be boring because I'm going to stick to my knitting, right? What CDP needs to be able to do is to service all of those stakeholders with being able to create the same data set that's used again and again. Sometimes I think about it this way, is that we often talk about harmonization, and it was great that David brought up ISSB, because CDP's thrown our chips into that ring pretty solidly. We're a huge partner of ISSB, and we're fully aligned. We're the only platform by which a disclosure can fully align with ISSB. Does that mean that that's aligned with all the other compliance mechanisms out there? Not yet, but there's a core there that we can continue to write once and use many. And I guess as I'm reflecting on this, I start thinking, actually, what is it that we're trying to service here? I'm going to give you guys a big reveal. Investors are not the biggest driver of disclosure. The customers are. Yes. So actually, if what we're trying to do is to drive core disclosure so that we've got comparability in a sector, in an industry, or in any other match you want to make, encourage your companies to actually start becoming supply chain owners that ask for that data, because that's when the data starts getting revealed much more quickly. And we know this, we have those facts. So again, I think that part of what we need to start doing in order to be able to service all of these different actors is by thinking about how is it that we can most efficiently react to the needs and the challenges, and almost taking your last question, the barriers to being able to unlock some of this data for good use. I'm delighted that we're all talking about action. That is absolutely where we need to be. And we also need to think about who else in other parts of the ecosystem are actors too, so that we can actually make sure that that fits together. My last point is about policy, and I think that a number of my fellow panelists brought up policy and governments as being one of the critical paths. You as investors can price that. Right? When there's a regulation or when there is a compliance-driven requirement in a jurisdiction or in a sector, you can price that in to your companies and your portfolios to understand, are they there, are they not there yet? This is a really good tool. And if we're thinking about the big picture, we're all looking at the various COPs coming up. Baku is one, but everyone's looking ahead to Brazil as well. And Brazil also is the place where new NDCs, nationally determined contributions, are put into place. What the heck do those measure? Because the only thing that a country can measure in terms of that goal, that target, is their own spending and policy. The rest is the real economy. The rest is the economy that's within their jurisdictions. So I think we, again, need to start thinking about how do we join all of that up. If we have the data, let's make sure that we're thinking about it that way, because you as investors are going to be able to see which countries and which of your companies are doing business in those countries are making changes to their legislation and their policies, and how is that going to affect the ecosystem. And then your voices become really important to make sure that we are not entering a phase of climate policy arbitrage, and making sure that actually we're really focused on those main goals, which is we're all here with the principle that says we want a sustainable future. Trying to keep our eye on that prize, I'd say, is the most important thing for all those stakeholders that you listed, but also as to why we're all here.
Thank you. Anyone else want to offer in on that question? Or just how we come together? I'm using it as a little bit of our panel before we head into a couple of great questions we have from the audience.
I would say that I would encourage companies, all companies, public, private, including GPs, to start setting targets. And I'm not asking for the moon, but realistic targets to start thinking about their impact and reduce it. 10, 15%, get on the bandwagon. Just that process is highly educational internally, as I mentioned earlier, and potentially could be used as a marketing tool. So small steps and grow from that. It's, too often we hear, especially from private equity GPs, oh, well, we own these companies only 5 years. We're in the process of mergers and acquisitions. We have other things to think about. It's the next merger, the next acquisition, the next this. And there is never any time to set targets. Well, it doesn't matter if you own the company for 5 years. Get it moving. Get it on the bandwagon, have the right dialogues so that the next owner can build on that.
Excellent.
I think, if I may, building off of that exact point, there's opportunities for us to build the right capabilities and coalitions within our own sectors or parts of the capital stack, and then find ways for those to connect. I would be remiss if I didn't talk about the role of the ICI. I'm privileged to lead the Net Zero Working Group of the ICI, which is a member-led organization within the private market specifically, who are really intent upon driving decarbonization action within our own portfolios, but very importantly, also sharing capabilities and best practices, which we talk about a lot generally, but this has come to fruition in very specific ways over the course of the last couple of years. Last year, there was a private debt working group that released a really helpful sort of how-to guide for CFOs in the private markets to think about Scope 3 decarbonization. This last year was a really important movement or moment when we released the PMDR, the Private Markets Decarbonization Roadmap, which is meant to be a method or capability to articulate decarbonization across your portfolio and different assets, and that dialogue between LPs and GPs is really important. And I think what this all comes down to is what our individual levers are. The levers that we might deploy in debt are naturally different from equity and from those structured equity versus buyout. So we have to get really smart within our own industries and then one to the other to think about how you actually deploy the right kind of levers in the right kind of context, because sometimes that doesn't always apply naturally. And so the more that we can have that cross-fertilization and dialogue among the capital stack to understand where and how you can deploy what capability or what lever, that will make that action forcing mechanism really practical.
Standing.
I would completely agree with that. We recently had a meetup of net zero asset manager signatories in Australia and New Zealand, and there were just these buckets of challenges that everyone was facing, and they were all kind of trying to work through them on their own. So being able to facilitate connections with people who'd been through that issue or who were trying to solve for the same thing at the same time, just I think everyone found that a really valuable experience. And then, like you say, also then talking to other people within the value chain, like talking to our clients about how we can support them and how we need their support to implement our net zero commitments, because if we're all heading in the same direction, we all need to be working together and supporting each other to get there.
So it's more conversations like this with everyone talking across each other than to each other.
Yeah. I mean, so yesterday, Catherine McKenna was talking about the importance of engaging policymakers. We might feel that we're all kind of engaging and doing more of that, but she was saying, well, actually, it's not, relative to some of the kind of naysayers and pressures against, governments from taking kind of meaningful action. We all need to get a lot louder and more coordinated around that, as well as kind of obviously real economic policy. There's also, I mean, on the disclosure point and on transition plans, a bit technical, but S2 doesn't, the ISSB S2 standard doesn't actually have, it requires companies to publish a transition plan if they have one, but it doesn't actually set out what should be a good transition plan. Now, there has been work done by GFANs working across the financial sector. What is the expectation from the financial sector for corporates on their transition plans? And then that was picked up by the Transition Plan Task Force, which has developed really useful guidance setting out what should a transition plan look like. And just in June this year, that's been picked up now by ISSB. What we now need to see, though, again, we need to get pressure and focus on this forward-looking information, because it's really that engagement between the financial sector and corporates around transition plans where so much of the impact can happen. But we do need now get a consistency on transition plans. There's a bit of a danger that we have a situation like taxonomies where every different jurisdiction comes up with a completely different methodology and framework. We need to work together to stop that from happening.
Excellent. Thank you. I've got a couple of really practical questions, and I know we have limited time, but I think I'd be remiss because there's a lot of interest in them. So I'm gonna share them with the panel. But one of the ones that we're getting a lot of support for is allowing brown to green investment in portfolios is a contentious topic for investors seeking to green their portfolios and grow the green economy. Yet we know it's necessary. Is there a role for smaller asset owners to include brown to green in their portfolios, or should this be left to the larger investors? Yeah,
I'm happy to pick up. I think it's relevant for everyone, and sometimes we talk at cross purposes to one another when we're talking about different parts of net zero or climate investing. And actually, I draw from some useful categories or buckets that GFANZ has come up with. So one is around investing in climate solutions, and that is a distinct piece. And you have the focus around that. You've then got kind of aligned and aligning, which is relevant for all sectors of the economy. How do they start reducing their emissions? How do they get onto the relevant pathway for their sector? And then you've got actually, managed phase out. So industries where actually ultimately there needs to be an exit, and what's the plan around how you get there. But these you can have distinct strategies across those. For some in particular entities you're investing in, there may be elements across all four of those which are relevant. But I think every investor needs to be thinking about each part of that.
I would say that's a very important question because, yes, there's some very big investors, but in the end, even the very large ones are small in the universe of finance. And there's probably, I don't know what the numbers are, but there's probably a lot more money from smaller investors than there is from the big, the very large ones like CDPQ. So I say it's very, very important that everybody gets on that bandwagon. And obviously, smaller asset owners may invest through GPs because they don't have the capacity to do it themselves, but invest in funds that do that. Create strategies to do that, and find GPs that do that.
Excellent. And this is another one specific to you and some of the insights you've shared, Bertrand. But is CDPQ facing losses or underperformance for having decarbonized faster than its peers? But to put you on the spot, but are there other financial consequences for going faster than the rest of the world, given the energy price increase, for example? So.
That's a very easy answer to a very easy question, and the answer is a resounding no. We are a fiduciary. We pay pensions in Quebec. And therefore fiduciary duty and returns is number one and always will be. Just to give you a sense, and I know people mention we are out of the oil production sector, the rationale being that the oil companies are intent on increasing production, and that is clearly not in line with any climate objectives. So we decided to get out and reallocate the capital to green energy. The return of our green energy portfolio over the last 5 years was 18% per year. We're very happy to be out of the oil sector.
Thank you. That. And we've got 2 more minutes for our roundup, and I think this is our real chance for everybody to bring it home. I'd like all of the panelists to share what you would like other investors in the room to take away and action on their way home from PRI in person. So, David, I'm going to start with you and just be...
I guess I talked about engagement with policymakers. I think that's big. I think it's also engagement with the ecosystem. So, for example, when we're working with our peers in the Net Zero Financial Service Providers Alliance, we can go so far. What's, I think, really helpful is to say, for example, asset owners start to say, this is what we expect to see from you. Obviously, we're providing a lot of the tools and capabilities, but we need to have that ambition and that kind of cut through from the ultimate clients.
Excellent. Thank you. Kate?
I think thinking about what your spheres of influence and levers are as an asset manager and as for centre investor, I have particular particular levers and spheres of influence, and then other areas where I don't have influence. So just really thinking smartly about how to pull those levers in the most effective way, and how to collaborate to do that as well.
Brilliant. Bertrand?
I would stress the need to collaborate, the power of collaborative initiatives. We need to speak with one voice. Companies, if they hear different voices, governments, if they hear different voices, end up bewildered, they don't know what to do. We increasingly need to speak with one voice to resolve this great challenge, and there are plenty of collaborative initiatives that help us do that.
Elsa?
I think the opportunity to think about the full universe of capital that's being moved around, whether from an allocation perspective or from an investment perspective, from a lending perspective, and exactly as Kate said, where do you have your own levers to actually make those allocations or investments very specifically applicable to the decarbonization of the real economy, and where can you work with others along the capital stack to make the whole of the economy transition happen in a more practical way?
Thank you. And Sherry?
I guess the take-home point is, what role can you play in driving efficiency in the climate and nature data space? How can we make sure we're not remaking wheels? How can we make sure we're sweating the asset, which is the data to be used? Because if we don't do that right, the Earth can't wait.
Brilliant. Thank you so much, David, Kate, Bertrand, Elsa, Sherry. You've been a fantastic panel. I appreciate your candor and your interplay. Thank you so much for joining me on stage today. Thank you to all of you this morning. We look forward to having the opportunity to interact with you over the course of the conference. There were a number of questions. If you did not get a chance to actually address them, which we didn't today, I'm sure the panelists would be happy to talk to you after the session over the course of the conference. So thank you, and thank you, PRI, for the opportunity.
Thank you.